Meet Sarah. She's 25, works a 9-to-5 job, and has $5,000 in savings. But here's the problem. That money is just sitting in her bank account, losing value to inflation. She wants to invest, but doesn't know where to start. Sound familiar? Now imagine if Sarah had followed Warren Buffett's investing principles. That $5,000 could grow to $50,000, $100,000, or even more over time. But here's the catch. Most people never take the first step. They get overwhelmed, make costly mistakes, or chase get-rich-quick schemes. What if I told you that Buffett's success isn't about luck or genius? It's about following a few simple principles that anyone can use, even if you're starting with just $100. In this video, we'll break down Warren Buffett's top 5 investing principles for beginners. By the end, you'll know exactly how to start building wealth like a pro. Let's dive in. Before we get into the principles, let's talk about why Warren Buffett is worth listening to. At 93 years old, Buffett has seen it all: market crashes, recessions, and booms. Yet, he's consistently outperformed the market for decades. How? By sticking to a few core principles that anyone can follow. But here's the problem. Most beginners fall into the same traps. They chase hot stocks, panic during market crashes, and end up losing money. Sound familiar? That's why Buffett's principles are so powerful. They're not just about making money. They're about avoiding costly mistakes. So, let's break down the first principle. And trust me, this one alone could save you thousands of dollars. Warren Buffett once said, "Never invest in a business you cannot understand." Sounds simple, right? But here's the thing. Most beginners ignore this. They hear about the next big tech stock or cryptocurrency and jump in without a clue. Buffett calls this your circle of competence. Think of it like this. If you're a coffee lover, you probably know which brands are winning. Maybe it's Starbucks or Dunkin'. That's your circle. But if someone tells you to invest in a biotech company developing a new drug, and you have no idea how that industry works, stay out. Why? Because when you invest in what you understand, you make smarter decisions. You know when to hold, when to sell, and when to ignore the noise. So ask yourself, what's in your circle of competence? And no, your TikTok addiction doesn't count. Unless you're investing in ByteDance, of course. Now that you know the importance of sticking to what you understand, let's talk about the second principle. And this one is all about playing the long game. Here's a hard truth. The stock market is not a casino, but most beginners treat it like they buy stocks hoping to sell them in a week or a month for a quick profit. And guess what? They lose. Buffett's approach is the opposite. He says, our favorite holding period is forever. Forever. That means he buys companies he believes in and holds them for decades. Why? Because time is your greatest ally. Let me show you something. If you had invested $1,000 in Apple 20 years ago, it would be worth over $300,000 today. But here's the kicker. Most people wouldn't have held on that long. They would have sold after the first 10% gain. So, how do you develop the patience to think long-term? That brings us to principle number 3, and it's all about controlling your emotions. Here's a secret. The best time to invest is when everyone else is panicking. Buffett calls this being greedy when others are fearful. Think about 2008. The market crashed, people were selling their stocks in a frenzy, and Buffett, he was buying. He invested billions in companies like Goldman Sachs and GE and made a fortune when the market recovered. But here's the challenge. It's not easy to buy when everyone else is selling. Fear is contagious. That's why Buffett says, be fearful when others are greedy, and greedy when others are fearful. So, the next time the market crashes, will you panic and sell? Or will you see it as an opportunity to buy great companies at a discount? Now that you know how to handle market crashes, let's talk about the fourth principle. And this one is all about protecting your money. Buffett's fourth principle is simple but powerful. Always leave room for error. He calls this the margin of safety. Here's what it means. If you think a stock is worth $100, don't buy it at $100. Buy it at $70 or $80. That way, even if you're wrong, you're less likely to lose money. Think of it like buying a car. If the seller says it's worth $20,000, but you negotiate it down to $15,000, you've built in a margin of safety. If something goes wrong, you're still protected. But how do you know what a stock is really worth? That brings us to the final principle, and it's the most important one of all. Buffett doesn't just buy stocks, he buys businesses, and not just any businesses. He looks for companies with strong moats, excellent management, and consistent earnings. What's a moat? It's something that gives a company a competitive advantage. Think Coca-Cola's brand or Apple's ecosystem. These companies can withstand competition and keep growing for decades. So, before you invest, ask yourself, is this a company I'd want to own for the next 10, 20, or even 30 years? If the answer is no, walk away. And no, your cousin's startup selling glow-in-the-dark socks doesn't count. So, there you have it. Warren Buffett's top 5 investing principles for beginners. To recap: 1. Invest in what you understand. 2. Think long-term, not short-term. 3. Be greedy when others are fearful. 4. Always leave a margin of safety. 5. Focus on quality companies. These principles have made Buffett billions, and they can work for you too. But here's the thing: knowledge is useless without action. So, pick one principle to focus on this week. Maybe it's researching a company in your circle of competence, or setting up a long-term investment plan. If you found this video helpful, hit the like button, subscribe, and share it with a friend who's just starting their investing journey. And let me know in the comments, which principle are you going to apply first? Remember, the best time to start investing was yesterday. The second best time is today. So, take that first step and let's build your wealth together. See you in the next video.